Welcome to a short video on the capital asset pricing model, also known as CAPM. Now, CAPM is one way in which financial professionals quantify risk. It is also how companies determine the cost of issuing equity in the weighted average cost of capital equation. This is why the equation is on here twice. Now let's look at the equation. This equation here says the return on a stock is equal to the risk-free rate plus the difference between the risk of the market minus the risk-free rate times beta. Now the risk-free rate is the rate of return for a treasury security. Now the risk of the market, or the expected risk premium here, is the quantifiable risk to own equity over treasuries. Now beta is the part of the equation I feel is the most important. Now I suggest that you watch my video on how to calculate beta. This is how we quantify individual risk. The higher the beta, the more risky the stock, therefore the higher the return. Now here is the visual representation of the capital asset pricing model. It is referred to as the security market line. Now riskless securities have a beta of 0 here. This line is the security market line. Its slope is equal to the expected risk premium, or the risk of the market minus the risk-free rate. When we have an increase in the expected risk premium, the slope also increases of this line, and here it is in red. Increasing the risk-free rate shifts the entire line up. Now you can see as the beta increases, so does the calculated returns. If the return is greater, the residual amount is called alpha. And finally, gold is considered one of the few negative betas.